Well, rising bond yields in India and the US have been making headlines over the last few days. So why do bond yields rise and how is that related to the price of the underlying bonds? And why should you be bothered at all? Well, watch this video to find out. But before that, don't forget to like and share this video and subscribe to the Moneycontrol YouTube channel. Now, bond prices and yields move in opposite directions. Why is that? Well, that's because of the fundamental relationship between a bond's fixed interest payments and the changes in the interest rates in the prevailing market. Now, this relationship is known as the bond price yield relationship. Let me give you an example. Imagine you have a bond that you bought for 1,000 rupees with a fixed interest rate of 4%. Now, this means the bond pays you 40 rupees in interest every year. That is 4% of 1,000 rupees. Now, let's consider two scenarios. One where market interest rates rise and the second where they fall. Let's consider the first scenario when market interest rates rise. Let's say that after you buy the bond, market interest rates rise to 5%. New bonds being issued now offer 5% interest rate. If someone wants to buy a bond from you that pays 4% interest, which is the bond that you own, they wouldn't be willing to pay the full 1,000 rupees for it. After all, they could get a new bond with a higher 5% interest rate elsewhere. So to make the bond you own more attractive, you might have to lower the price at which you're willing to sell it. As a result, the bond's price decreases. Now, if you are willing to sell it for 950 rupees, for instance, the effective yield on that lower price becomes higher than 4% for the buyer, making it more comparable to the 5% market interest rate. Now, let's consider the second scenario, when the market interest rates fall. Let's imagine that market interest rates have dropped to 3%. Now, your bond with a fixed interest rate of 4% becomes more attractive because it pays a higher interest rate than what's currently available in the market. As a result, if you wanted to sell your bond, you could ask for a higher price, perhaps 1,050 rupees. Now, this would make your bonds yield closer to the 3% interest rate prevailing in the market. In summary, when market interest rates rise, existing bonds with lower fixed interest rates become less appealing, causing their prices to fall. Now, this decline in price increases the bond's yield to make it more competitive with the higher market rates. Conversely, when market interest rates fall, existing bonds with higher fixed interest rates become more attractive, causing bond prices to rise. In short, the value of your bonds depends on the prevailing interest rates in the market. Now, why should you be bothered about rising yields? Because it signals that interest rates in the system are rising. Governments can borrow at the lowest interest rates, say 6%, because there is zero risk of default. Now, it will be slightly higher for a company with high credit rating, say somewhere around 7%. But it will be slightly more for a company with a lower credit rating, say 8%. Now, when the yields on government bonds rise to 7%, it means that the government will now have to pay 7% to borrow money. Now, if the government refuses to offer that much, nobody in the market will come forward to lend it money. And when the borrowing cost for the government goes up, the interest rates for corporates will also move up accordingly. And when companies' borrowing costs rise, their profit margins come under pressure and they will try to recover the higher cost through higher prices for the products and services they offer. Well, for more such videos, keep following Moneycontrol.